most really good active managers that are going to outperform for a long period of time are going to also underperform for a period of time. So if you're an impatient investor, if you can't stand underperforming the S&P 500 or underperforming your index, passive seems like the likely option. And so I think a lot of the move towards passive has been in that for that reason. I think another reason that people go to passive is they don't really know which active managers to trust or don't know which active managers will do well in the future. And so active management definitely has to evolve. They need to bring something to the table. So whether that's bringing less volatility or making decisions that allow investors to kind of stick through their investments over longer periods of time, that's really important. But the most important thing of all has to be communication. If you look at Warren Buffett, not only is he one of the best investors of all time, he's also one of the best communicators. And I think if you're going to ask someone to trust you and to really bear with you during those periods of underperformance, which are inevitable, then you really need to communicate what you're doing, why you're doing it, and it has to be really logical.
Hey everyone, welcome back to the Ignite podcast. Today we're thrilled to have Chris Zaccarelli joining us. He's the Chief Investment Officer at Northlight Asset Management and co-founder of Beacon Capital Advisory Group. He has a career spanning top institutions like Goldman Sachs, Lehman Brothers, and over 2 decades of trading, portfolio management, macro strategy experience. He's widely recognized as a voice in the investment world, regularly featured on CNBC, Fox Business, etc. Today, we'll dive into market dynamics, what's going on, portfolio construction, the role of human decision-making in the age of AI. Thanks for coming on, Chris.
Yeah, thanks so much for having me. This is great.
So you've held CIO roles at several firms. What's changed most in your investment philosophy over time?
Yeah, it's absolutely evolved over time. When I first moved out of Wall Street onto the CIO role, really on the buy side, I was focused so much on just absolute return, not worried that much about volatility, and didn't even think at all about taxes. And what I've learned over time is that ultimately, it doesn't matter how high returning your strategy is. If your clients don't stick with it, then it really doesn't matter what kind of return you get. So I've definitely evolved over time to think a lot more about not just how to get high returns, but how to get them in a smoother way. It's the ride that matters just as much as the destination. And so that's probably the biggest adjustment, with, of course, the addition of taxes being very important to most people. It's what you keep. It's not necessarily what you make. Those are the biggest changes, I would say, since I made the move.
That's interesting. And I think there's this move towards higher and higher allocations in venture capital, especially with foundations. I think Yale kind of pioneered that model, weighting as heavily as 30% in venture. Why do you think they took such a bold step? Is it just because they're really long-term thinkers, or what's going on there? Is it because you can tie up your money and not get it out for 10 years and not have these short-term, like sell at the bottom kind of fear pendulum swings?
I think there's a lot of factors. Clearly, if you're an endowment and your time horizon truly is forever or very long term, it's a lot easier to have investments in, have illiquid investments. But I also think they were looking to differentiate themselves. I think, public markets are accessible to, almost anyone, whereas private markets are a little bit more difficult to navigate in terms of how do you access them and how do you differentiate amongst, the better managers. And so I think, Yale really showed the way in terms of trying a different approach. And, and I would argue that for people who have access, can find the right investors, can really find the right vintages, even in terms of private markets, you can see great returns, both in terms of total returns, but also in terms of just correlation to the market being a little bit less. So it makes a lot of sense in a lot of ways, but clearly skewed a lot more towards truly long-term investors and those larger institutions that have the access and the manpower to do the due diligence and all the things that are required to execute that strategy effectively.
Yeah, that makes a lot of sense. How did your early years at Goldman Sachs and Lehman shape your approach to risk?
Working at companies like Goldman and Lehman have been so helpful just in many ways in terms of just, large scale companies, incredible training, really, really smart people. But, clearly having worked at Lehman and then seeing them go into bankruptcy many years ago now, but living it in real time, when I was at Goldman Sachs, looking back at my former employer, I think everyone was really surprised, of course, that Lehman went under, whereas other banks did not. But in hindsight, clearly, the idea of just using too much leverage, potentially expecting the former past to continue into the present, those are really big risks that people make all the time, and you don't really think about it. It's clearly that once in a generation or once in a lifetime type of risk that people literally don't see every day that can really come and bite you. And so it's important to look around, not always look at what you're chasing, but look at where you are and make sure you're looking around corners. There could be some dangers that are not obvious when you're just following the trend day to day.
Risk is a funny thing. We were talking before we started recording, as an analyst way back then, 20 years ago on mortgage-backed securities, and we'd have a client, basically, like Washington Mutual, who's now out of business, of course. They would give us a whole loan portfolio or mortgage-backed servicing rights, and they would just give us the assumptions to run in our Monte Carlo simulations. And, they were just faulty, right? They just didn't have any idea on these no doc liar loans, what the default rate would be. They'd be like, make it 3%, make it 4%. It was like, I think it might be like 8 to 10%, based on what we see in the data, right? And they're like, no, make it 4%. What do you think that psychological mechanism is that when these institutions are, not willing or able to, be honest with themselves on their assumptions and their models? And like, what are the repercussions?
Yeah, well, I mean, obviously, models themselves are always imperfect, but if you put bad information into even a good model, you're going to get bad results. And you look back to the global financial crisis; it's the ultimate example of relying too much on models, potentially, not looking at a large enough sample of data. Looking at, bankruptcies from 1970 to 2008 is a lot different than looking at bankruptcies since 1928 to 2008. There's so many mistakes are made. You have to look back on that period of time and think it was a series of things that each and of themselves would probably be survivable, but combined created this really awful situation from so much excesses in lending, the wrong incentives, too much leverage, and it's really the age-old problem of if everyone is trying to keep up with the Joneses, sooner or later, risk management and risk kind of falls to the wayside, and you're only worried about how much can I make. And I think ultimately institutions, because they're made up of people, end up in that same situation where you have the kinds of mistakes that any one person would make, full institutions will make. And you're giving a great example of something which in hindsight seems absolutely way out of line. But at the time you thought, all right, well, these guys are playing a little fast and loose with the rules, but they're the customer, so we'll give them what they want. And that's that can lead obviously to problems as well.
Yeah. Yeah, it was a really interesting time. So you've moved between large institutions and independent advisory firms. What have you gained from each of those environments?
Well, as I mentioned, on those large firms, I mean, they're such a great place to learn. You have incredible training, you work with incredible people, really, really smart, and you have access to, a lot of resources. And so I really think it was instrumental for me, and it really helped me to develop my process in terms of a lot of the things that I do today. I mean, even the data that I had at Goldman Sachs, I have a Bloomberg terminal now and I have access to a lot of the same data, but at the time I didn't. Goldman had this fundamental viewer, which was hundreds of columns of metrics across thousands of companies. And I was able to access that data, come up with my own models, try to score them, try to rank things, think a lot about from a quantitative point of view, how could I analyze securities of a large universe? And all of that was possible at a large company, which I could never have done, in the smaller institutions that I went to. On the other hand, all you're doing at a large company is making extremely wealthy people even richer. And so there's so much more to be said for, working for a smaller company, making a difference in people's lives. I still work with a lot of wealthy people and make them wealthier, but I deal with a lot of people who are more average people, or even people who are, only slightly wealthy instead of extremely wealthy. And the idea that you can have, thousands of people that you can make their retirements better or more secure because you're stewarding their money in a responsible way is infinitely more rewarding than just almost playing a video game of trying to rack up as much money as you can make in an abstract way. So I find it a lot more fulfilling. I feel like there's a lot more purpose to what I do, and it feels more like I'm doing something in a positive way, as opposed to just trying to be good at something for the sake of being good.
Yeah. So let's talk about markets and strategy. We're sitting, near mid 2025. We have, all the tariffs are on whatever the 90-day hiatus is. How are you advising clients right now in this current macroeconomic uncertain landscape? And how should investors be positioned here for the rest of the year?
Well, I'll take that in two parts. I mean, as usual, for most clients, you want them to be long-term investors. You want them to have a plan. If there are market dislocations, which clearly we've had, you want to take advantage of those. And so often you want to do the opposite of what's comes natural. Most clients, when they see volatility, they want to go to cash. They want to basically get out of the market. And that's exactly the wrong thing to do. If you have the right asset allocation, if you have the right diversification ahead of time, this is actually an opportunity for you to either rebalance or to upgrade what you have in your portfolio. On the other hand, we do think tactically as well. And even though we think of ourselves as strategic investors, we are active investors. We do try to take advantage of opportunities. And right now, the uncertainty level is so high. So I think at the very least, for people who weren't already diversified internationally, that's something that you need to be doing. There's no doubt in my mind that regardless of how this plays out, the ultimate result, one way or the other, is that international markets and potentially the dollar are going to be two sides of a coin which have changed. I mean, there's fundamental change right now from a regime point of view, both in terms of geopolitics and the real world, but also in markets. So that's one thing. The other thing is, for those people who are thinking of the dollar as a reserve currency and treasuries as a place to hide out, I don't know that that will change on a dime, but clearly it's another example of you see stock market selling off, treasury yields going higher. That's not typical. You don't normally see that. And so in that case, I think you have to start thinking about what are other ways to diversify your portfolio. So, things like gold in small amounts are making more sense in this environment than they have really any time since post-World War II.
Yeah, that's really interesting. Yeah. Usually when the stock market is declining, people are selling and they're seeking security. And so they buy bonds, treasuries, and that demand drives yields down. But we're seeing kind of something we haven't seen in kind of since, World War II, which is the stock market's going down, but also yields are going up, which is just weird. What do you think is happening internationally? Are investors just kind of looking at the U.S. as not as trustworthy as we once were?
I mean, I think it's a confluence of factors as they always are. But I do think at the margins, you have to imagine, and we'll see some flow of funds data in a few weeks and see if this can be confirmed or not. But you have to think at the margins, there's a lot of international investors that have been investing in the United States, absolutely within our stock markets, looking at the Mag 7, looking at opportunities, as global investors. They saw some very fast growing companies and they took advantage of that. And I'm sure investors around the world are momentum investors internationally, just as they are here domestically. And so I think you saw a lot of investors who said, well, wait a minute, a large part of my portfolio is the Mag 7, same as US investors. And unlike US investors, all of those investments are in dollars. They may have euros as their home currency. They may have yen. They may have other types of currencies. And so all things being equal, if they're overweight the United States and or they feel like they need to have less of their portfolio in dollars because that's not their home currency, it just makes sense that they would repatriate. And what's interesting is not only are they potentially pulling money out of the US stock market, I think they're also pulling money out of the US bond markets. And likewise to what I said, if you look at central banks, a lot of the demand for gold probably is coming from central banks. They're looking also to diversify their own holdings, not hold as many treasuries, not hold as much US dollar denominated assets. And so I think it's a combination of those factors. And at the end of the day, once the tide turns and the Mag 7 are no longer the top performing assets anywhere in the world, there's also a natural reaction to go find higher performing assets elsewhere. So I do think it's a combination of factors.
Yeah. Good analysis. Speaking of passive versus active, there's been this rise of passive strategies. How do you think active management needs to evolve?
Well, if you look at passive, I mean, you have to imagine there's a lot of factors at play there. On the one hand, I think, investors really feel like it's difficult to find an active manager. Maybe they're impatient with returns from active managers. And that's the part that I think a lot of people don't realize is if you want an active manager that's going to beat the benchmark, of course, they need to be different than the benchmark. And every great active manager, those ones with 20, 30, 50-year track records like Warren Buffett, who've beaten the averages by a long shot over time, they've underperformed at 1 year, 2 years, 3 years at a time. Most really good active managers that are going to outperform for a long period of time are going to also underperform for a period of time. So if you're an impatient investor, if you can't stand underperforming the S&P 500 or underperforming your index, passive seems like the likely option. And so I think a lot of the move towards passive has been in that for that reason. I think another reason that people go to passive is they don't really know which active managers to trust or don't know which active managers will do well in the future. And so active management definitely has to evolve. They need to bring something to the table. So whether that's bringing less volatility or making decisions that allow investors to kind of stick through their investments over longer periods of time, that's really important. But the most important thing of all, it has to be communication. If you look at Warren Buffett, not only is he one of the best investors of all time, he's also one of the best communicators. And I think if you're going to ask someone to trust you and to really bear with you during those periods of underperformance, which are inevitable, then you really need to communicate what you're doing, why you're doing it, and it has to be really logical. If your clients can see that you're doing things that make sense, even if you aren't following the benchmarks, I think they're more likely to stick with you and to trust you. And that's why those are really big factors in how active management is going to need to evolve if it wants to compete and succeed in a world which, to your point, has become increasingly more focused on passive management.
Yeah, and I think with all the macroeconomic uncertainties and economic weirdness happening, you might describe it, people are getting more fearful and more reactive. And sometimes passive strategies can kind of cool the hot flames of your fear, uncertainty, and doubt of the markets, right? For people who can't stomach the higher beta, around the volatility.
Yeah, I think that's right. And I think, it's that feeling of, someone else is doing better than I am. Why not just, get with the averages? On the other hand, I'd also remind people, you could have been in the S&P 500 passive index, SPY, or pick your ETF, and you would have been down 54% peak to trough. So just because you own an index doesn't really protect you from seeing, your net worth feel like it's evaporating at least on paper. Again, I would just caution people that, just like every other invention in the history of the world, there is no silver bullet. Passive does not protect you in all cases, but absolutely, I think a lot of people have moved to passive and they've been happy with what they've seen so far. Again, caveat emptor to some extent.
Yeah. So how are you walking your clients through thinking about asset allocation in 2025? You got your classic, public equities, large cap, mid cap, small cap. You got your bonds. You got real estate. You have gold, commodities. You have private markets like venture capital, private equity. How are you kind of thinking about, as a active money manager or wealth manager, allocating in these different asset classes?
Well, one of the things I would say, or, if you want to call it a benefit, or one of the things that have gone well, at least in terms of, all this market uncertainty, is for years we've been telling clients, just owning 7 stocks, or just owning the United States, or just owning the S&P 500 isn't a truly well-diversified strategy. And if you look from, March of 2009 to at least 2019, but even if you, give up a few hiccups in 2020 and 2022, it seemed like the only thing to do was to buy US large caps, if not, the NASDAQ, top 10 names. And this market is really showing you that that doesn't always work. Furthermore, I don't think this is just a blip in terms of maybe what we've seen in the past where we're going to go right back to where we were before. I mean, I think you alluded to it, but we're all seeing these huge shifts. If the United States is going to become more protectionist, if it's going to become more isolationist, if we are going to rewrite or change our existing alliances and how we interact with the rest of the world, things are changing. You never want to say this time is different or anything to that effect. So many things of investing will be true forever, but you have to acknowledge that a lot of the patterns, a lot of the trends that have been in place for many years, if not many decades, those are starting to change. So diversification, the whole point of diversification, if it's done properly, is to give you an opportunity to have certain parts of your portfolio do well when others are doing poorly. If you have an exactly homogeneous portfolio, and I would argue owning all tech companies or very correlated assets are not well diversified, the converse is true. Having international exposure, having some commodities exposure, having some private investments or non-correlated assets to your typical stocks and bonds really help. And so we've been doing all of those things. And I think one of the things that has really helped clients is to really point out to them, first of all, we've got a plan, we're following it. We do have parts of the portfolio that are holding up. And we do spend a lot of time talking about tail risk hedges and things that can be done at the margins. We're the first to tell clients, we're not an absolute return strategy. Largely speaking, when the stock market goes down, your portfolio will go down, your account balances will go down. That's not our objective. We're not trying to prevent losses. What we are trying to do is go down slower than the market, make sure that you're holding the value of your investments. And that's important for 2 reasons. One, less volatility typically will keep people more calm and stick with things, which is the most important thing. But the other part we talk to people about is if you go down slower than the market, when things do rebound, and ultimately things always do rebound, you'll be back to flat and making money more quickly than if you go down as fast as the market. And those are things that people don't really think about during bull markets. But once you enter bear markets or periods of dislocation, it becomes really, really important. It's that lesson that people learn over time, but then continually forget.
And I would imagine you're doing some like tax loss harvesting and, selling correlated assets to, and buying others to kind of harvest those losses. And you also have a hedged equity strategy, and I'd love to know how it behaves in different market environments.
Yeah, absolutely. And you're absolutely correct. We are doing tax loss harvesting for those taxable accounts. We do have a lot of retirement accounts, or we do have institutions that have, that are not taxable. But for those accounts that are taxable, it's a great opportunity to tax loss harvest. I kind of alluded to it before in terms of looking for upgrading your portfolio. When the baby gets thrown out with the bathwater, you will have an opportunity to sell some assets which aren't as good as other ones that are on sale. But as far as the hedge equity portfolio goes, that's something that I put together. It's kind of a combination of some of the things that I was doing at Goldman Sachs, which had nothing to do with private retail clients, more in terms of options trading, derivatives, things that I learned along my time, at the larger institutions. But the hedge equity strategy is relatively straightforward in terms of portfolio construction. Taking a 60-40 benchmark, your typical 60% equities, 40% bonds, you modify it slightly. So you say, okay, given an account size, I'm going to put 70% into equities. Hopefully you're buying good companies like you always are, somewhat diversified by sector, diversified by, region or size of company. And then with that remaining 30%, you're using a combination of fixed income and then a layered index put option approach. And what that'll do is in strong up markets, you'll get the feeling of a 70-30 in terms of 70% upside because you truly are 70% long. But when markets really disconnect and you see steep drops in the market, similar to what you saw maybe in 2022 or even in 2020, put options have asymmetric returns. So they'll explode in value if the market really drops. And so what that'll do is give you a feel of almost like a 50% correlation to the stock market as opposed to your original 70%. So it's a pretty interesting strategy. It gives people a lot of the upside in a strong up market. It gives people a lot more cushion on the downside when things go wrong. But like every strategy, it's got an Achilles heel, and that Achilles heel is in a sideways market, you're basically not gaining much from your equities, just going sideways, and you continue to bleed the premium from your put options. So it's not such a great strategy in sideways markets because you'll continue to lose money, underperform a 60-40 or even a typical 70-30 because you're spending that money on protection that you're not using. But for a lot of clients, it's a way for them to participate in a more aggressive portfolio, especially if they have a longer time horizon, but keep them a little bit more calm if things go wrong. And so it's an interesting strategy for sure. It's not for everyone.
That's interesting. Yeah. And so for listeners who might be going like, what's a put option? It gives you a right to sell, right? And so like when would you want to do that? When the equities go down, right? And that's when it's in the money. And so you pay like an option price or a premium to basically give you the right to sell at a certain price. Am I describing it correctly? It's been a while since I looked at these.
That's exactly right. Another way to think about it from an analogous point of view is it's similar to buying insurance. And that was the funny thing, that people who hated the strategy would get all upset. I'm losing so much money on my put options. Why am I doing this? And you kind of remind them, well, when you buy home insurance and your house doesn't burn down, you don't feel bad about the $3,000 or $10,000 a year you're paying in insurance premiums. For insurance, you really don't want the insurance to pay off. You'd much rather the house survives than it burned down and you have to cash in your insurance policy. But that is a hard thing for people to get their arms around because any part of the portfolio that shows red or that is going down, people point to it and say, let's do less of that and let's do more of something else, without understanding the two go together. You can't divorce the two from each other, at least in the hedge equity strategy.
Yeah, and I'm guessing in this first quarter, especially after the tariffs and the volatility in the market, some of those put options were in the money and paid off quite nicely.
Yeah, it's in those periods of dislocation that it works really well. But again, temper people's expectations. It's just cushioning you from going down as quickly as the market. Definitely is not an absolute return vehicle. So it's one of those things where you're glad you have it, but then you wish you were just all in cash. And so there's no making everyone happy. There's always people who say, look, I just want you to put me in the market when we're going up. And then before it goes down, just get me out because, that's what I'm paying you to do. And you say, that's not really how investing works.
Yeah, easy as that. Just time the market. No big deal, right?
Yeah, it's really easy. No problem.
So you're a Cornell-trained computer scientist and a former derivatives trader. Very interesting background. How do you see AI and automation reshaping investment management?
Yeah, I mean, it's a really interesting time just with artificial intelligence in general, ChatGPT or any of the, the new inventions that we've seen recently. And so, I think if you look at just automation in general, computerized trading has been around for decades. We've seen a lot of automation. We've seen, markets move much more quickly than, human beings could ever move, even before really AI showed up on the scene, at least in such a big way. And so, whether that's taking an economic data release or whether that's, reading news headlines and reacting more quickly, we've seen that market structure change. Trading has changed dramatically over the last few decades. On the artificial intelligence side, it'll be really interesting to see. I mean, we still haven't seen AGI, the idea that we're going to have, generalized artificial intelligence. And, when that comes, that could be ground changing. But at the end of the day, I really think about markets in terms of really being run by people. So, even if you have a computer system that's programmed by people or that's plugged and unplugged by people because they feel like it's not working, so much of markets are really based on human emotion, behavioral psychology, just behavior in general. And so even when we have AGI, I really wonder, are computers going to be able to interact in markets better than people do without even understanding how people operate? You're going to have a computer that is going to understand emotions, is going to understand, illogical choices, behavioral mistakes. And you have to wonder, if a computer understands all of those things so well, are they then going to be susceptible to the same kinds of mistakes? And if they're not, how well do they really understand those characteristics? So I have to have a feeling that it's going to be one of those things where people using computers or even people using artificial intelligence might be able to outperform other people for sure, and potentially just pure AI on its own. Right now, it's a little bit more science fiction than a reality. We'll have to see how that unfolds over the coming years, coming decades, for sure.
Yeah, I think it'll take a while. I think if you look at the internet, it took probably, a good solid 10 or 15 years for it to really impact everything, our economy, our industry, how, people trade online. And, and I think AI is no different. It's going to take a little bit of time. I'm seeing definitely an uptick in my throughput, as a small venture capital firm with a solo GP. You can use O3 to analyze things that, would take me 8 hours of just solid analysis time. Just plug in, hey, I'm gonna have to start up in this market and here's their deck and let's analyze it. And it's quite breathtaking what it can come up with. Speaking of tech, how are you integrating technology and data into the investment process at Northlight?
Yeah, so a lot of what I'm doing now is really kind of building on what I've done in the past at some of those larger institutions. And as I mentioned, when I was at Goldman Sachs, I had access to so much data. I was able to really build a lot of my own models. And despite having been a pretty serious coder and having built a lot of systems over time based on my background and what I did really in the beginning of my career, I'm still spending so much time within Excel. It's actually almost pretty funny that it's a joke amongst a lot of people who are on the trading floors or even on Wall Street today, where so much is done within what's effectively a 30 or 40-year-old process. But being able to take large amounts of data, being able to really kind of rank and score and highlight is really, really helpful. I mean, at the end of the day, I am a CFA, I am a value investor. I feel very strongly that every single stock I'm buying is a piece of a company. I really make sure that, even my public markets investments are based on buying businesses, partial shares of businesses. And so for me, there's really no substitute for human judgment. So much of what I do on the analytics and data side is taking a large universe, whether it's the S&P 500 or the Russell 3000, and boiling it down to a lot fewer names, but still evaluating them. There's so much of investing that I think isn't just based on the metrics. It's qualitative things, not quantitative things. Whether that's the quality of the investment, the management team, whether that's the true total addressable market in the future, not the current market, and ultimately, what you think a company's ability is to develop and maintain a sustainable competitive advantage. A lot of that's really hard to quantify. And so it's really that marriage between analytics and qualitative thinking and judgment. And so ultimately, I'm not trying to reinvent the wheel or try to invest in a way that's different than what, even Benjamin Graham was doing from back in the day. But what I am trying to do is take advantage of technology, take advantage of information, and really use technology as a way to leverage that. Similar to what you were talking about, it's a productivity enhancement to be able to digest 8 hours worth of reading in a much smaller period of time. Likewise, we can take in a lot more data and highlight a lot of promising opportunities, but we don't do any buying and selling. No final decisions are made by technology. It's really used as a way to make the analysis and the final decision take less time.
I love that. And something you said kind of perked my ears up, which was, value investing and versus just complete quantitative investing. It's why I like early stage investing as a VC. It's very much value investing. You're looking at the team, you're looking at the market, the timing, and there's an art to it. There's not like a formula. I mean, there is a formula. We have a framework, and you're looking at revenue and net revenue retention and things like that, and CAC. But it's more art than it is quantitative. And I really enjoy that part of it. Kind of the human messy part of early stage versus hey, I'm just sitting in a spreadsheet building this really complex model, and that's all I'm doing all day.
I love that you said that. I mean, really, I feel that way as well in investing in general. And again, I focus a lot more on the public markets and the private markets. But at the end of the day, it's an art and a science. Being an engineer, being very quantitative, taking the CFA curriculum and working all the way through, there's so many formulas, so many ways of doing, net present value calculations, looking at dividend discount models. And it's great to have a framework. It's great to have mathematics that will give you a specific number. But at the end of the day, if it was simple as that, everyone would be using a computer to trade. And clearly there's so few people have been able to do that successfully.
There'd be no arbitrage. Everybody would have perfect information with a perfect model and everything. There'd be no price discrepancies and no arbitrage. And therefore you couldn't beat the market. So everybody should be passive. And that's just not the case.
That's exactly right. And really it's marrying the art with the science that's so important. And that's what makes it interesting. You're absolutely right. If you could truly systematize something and get to the point where no extra thought or judgment was required, you just set it and forget it, then it would be completely boring. I wouldn't be in this space. I'm specifically doing this because I find it really challenging, and it's challenging because of the people aspect and the fact that it's always changing. Things that models or formulas will predict are a good starting place, but they're never the final answer.
Yeah. So how do you guide your clients through thinking about the split between public and private markets?
For most of our clients, depending on the size of their portfolio, really if they have a smaller portfolio, I think a lot of them will stick to either public markets, or they might get some type of liquid alternatives, whether that's using an ETF or mutual fund in order to access, truly, illiquid strategies or asset classes. I think you mentioned, real estate or REITs, or looking at a long short equity fund or venture capital, things like that. But for the most part, once you get to larger portfolio sizes, probably at least $10 million, if you're going to talk about putting 10, 20% of your money into an LP and looking at private investments, and up from there. And ultimately, it's back to what we were talking about in terms of the endowment model. I mean, clearly, Yale took it to an extreme and did it extremely well. But like all other investments, you're really looking to try to find non-correlated assets that are either going to reduce the risk of your portfolio or increase returns, hopefully both. So we really think of private investments as just another asset class, separate from bonds, separate from stocks, separate from commodities. And to some extent, you might even think of cash as a separate asset class, or you just subsume it under fixed income. But ultimately, having different asset classes in different proportions make more sense depending on what your time horizon is, what your risk tolerance is, what your return objectives are. And to us, we think private investments are just another piece of that puzzle.
Yeah, it's really interesting. The two mechanisms you described are, your portfolio size, 10 million or more, and definitely the percentage seems to be correlated with your portfolio size. And then your percentage of private equities or private markets, venture capital, private equity, other alternatives, let's just bucket them all together, also is correlated to your time horizon, it seems, as well. If like you're the Yale Foundation and you have tens of billions of dollars to invest, that allocation seems to go up and up and up. And I wonder if like it's, what you described earlier, which is like the rich are getting richer, because they're able to go into these riskier, long-term, illiquid asset classes that generate higher returns versus people that only have, a couple million to invest. And I wonder what the mechanisms are, if there are any, to, I don't know, open up venture capital and some of these private markets for your average, million, 2 million self-directed IRA kind of person. You've seen some of it, but there's no Russell 3000 index for seed stage and like startups, for instance.
Yep, that's exactly right. And ultimately, to some extent, it's not just the size of your portfolio. It's also, those other characteristics, your risk tolerance, your time horizon, as you mentioned. But we are starting to see ways to access that. So a lot of the barriers to entry in the past have been minimum investment size, and you can kind of bring that lower by bundling accounts together. So kind of getting that, that second fund, kind of commingled fund. And then you also want diversification. So there are approaches where you can get a larger fund together that has some diversification that allows you to split it into smaller pieces and then allocate it to your clients. And there are a lot of companies out there that are helping with the documentation and a lot of the extra administration and things that come with private investments, but it's still evolving. It's something that I think has gained a lot of traction. I think in 2022, when we saw inflation and stocks and bonds together, not really being able to diversify clients, at least in the short run, a lot more interest in private credit or other alternatives. Clearly, venture capital is a great example of kind of on the absolute return side of things. You could either think about it as, your small caps on steroids or maybe even micro caps or something else. But, lockup periods and a lot of the illiquidity of the investment, the fact that the investment itself is required to take a longer period of time, all of those factors would work against a smaller account where they might need to liquidate it at any time, or they might be part of a model portfolio, which is more scalable. And so I think there's a lot of factors at play, but I have seen a lot of inroads being made. And I do think over the next 5 or 10 years, you'll see a lot more cases where exactly access to those private markets will be finding their ways into smaller portfolios, all things being equal. Again, smaller, like 2 to 3 million as opposed to 10 or 20 or 50 million.
Right. Makes sense. Switching to kind of leadership legacy, what's the most underrated skill for modern CIOs today?
I think a lot of chief investment officers come in two camps. They're either incredible communicators and they spend a lot of time almost drafting letters, explaining strategy, and maybe not being as hands-on in the actual portfolio side of things. Or on the other hand, they're so into the analytics, so into the portfolio management. Clearly, it's going to lead to a lot of people who love their spreadsheets, are very introverted, and that's completely natural. It makes sense. But I think in order to be successful as a CIO, you really need both. It's not a matter of just from a marketing point of view and raising assets, which of course in all businesses you need to have sales. But on the other hand, it is also that case where if you are going to try to build a differentiated portfolio, try to do something that hopefully will really help your clients over a longer period of time, but then therefore is different than the benchmark, being able to communicate well to your clients why you're doing what you're doing and why it makes sense becomes increasingly important. So I think marrying those two skills, a lot of the really successful CIOs that I've seen are able to do both, but it does seem to be a little bit more rare. You fall into one of those other two camps, typically not having both capabilities.
So looking ahead, what legacy do you hope to leave in the investment management world?
So, when I was younger, I think I was always thinking, how do you change the world? How do you, create something incredible from a quantitative investing point of view, or, revolutionize some aspect of the market, and as I get older and I think a little bit more about, what really matters? Does it really matter that you somehow find yourself on a Wikipedia page, 500 years from now, or, in the time that you have, are you making a difference in people's lives? Is what you're doing have purpose? And so I just hope I'm able to just do a really good job for my clients, keep them invested for those difficult times, and get them to that really good retirement. Ultimately, if I can be successful in what I'm doing and help as many people as possible, doing what I love to do, then I'll feel really glad about it. And that's something that I'd be really proud of. And that's something I work on every day, hoping to get to that point.
That's really well said. I think when you're at the end of your life, dying on your deathbed, you're not like, gosh, I hope that Wikipedia page is like really long. Like nobody thinks that, right?
I don't think so. I don't think that's
the relationships and the lives you've touched. And I think that's really well said. And, something as we both manage other people's money, right? In a way, like I do it in investing in startups, so I'm helping them get a return, but I'm helping the startups kind of realize their dreams, and that feels good. And, same with you, right? Like you're helping people realize their financial goals and dreams, and you can feel good about that. You are doing well versus, living in a spreadsheet doing mortgage-backed securities like I was doing 20 years ago. Like, I don't know what I'm doing, I don't know how to directly affects anybody's lives, and probably negatively even. So
Exactly. Although again, it's those skills and foundations which allow you to be successful later on. But you're absolutely right. While you're doing it, even at the time, you're thinking, this can't be all there is to life. There must be something more than this. And you're absolutely right. That really is the trick is, how do you take whatever it is you're doing, make it as good as possible, and then learn from it and move on. It's often a lot of these dead end type of things that people get stuck in. It's really being able to break out of that and to try to do something that makes sense for you, has meaning for you. That's what matters the most, I think.
Yeah, I love that. Well, let's wrap up with a rapid fire. Equity or macro?
I'd say equity at this point.
And why?
Well, the reason is, if you think about the opportunities, really when the stock market's at all-time highs, that's rarely a great entry point. But if we see some dislocations like I think we're going to find over the next few months, if not couple of years, that's really a great opportunity to buy either private or public companies at some really good prices. And ultimately, your total returns are based on your entry price. It's right in the formula. So a lot of people hate it when markets are down, but ultimately all of your good money is made by buying in those down markets.
Index puts or tail risk hedges?
Tail risk hedges at this point, I think, again, going the other direction, there's so many different changes in the world. There's so many different moving pieces. Rather than completely changing your strategy, trying to anticipate what will happen in the future, I think you have to stick to your knitting, keep doing what makes sense, but you do need to add some type of protection, have that tail risk in place so that if some unexpected things happen, you're protected and you're able to continue with your existing strategy. I think that's the most important part.
What's more dangerous, duration risk or credit risk? right now?
You might be surprised to hear me say this, but I actually think credit risk. And the reason I say that is I really worry that everything we're doing right now will eventually put us into a recession. And even if we pull back from a lot of the policies that are on that 90-day pause, all of this uncertainty, all of this paralysis does cause companies to hold back on investing, hold back on hiring, hold back on doing projects. And if everyone pulls back all at once, you can hit that point of no return. And that's what I worry. At what point do we get into a recession, even without changing the trade policy, but just creating enough uncertainty that people reduce the activity that they're doing? So I worry a lot about recession and credit risk at this point.
Most unappreciated asset class in 2025?
So I think that's a great question. I mean, I think if you're talking about retail clients, just your average person, it's going to be, international equities or potentially gold or some type of diversifier. But if you think about, more institutional investors, people who are out in the world investing, I think people really underestimate just short-term treasuries. The idea that, having some liquidity in your portfolio that's going to hold up no matter what happens, again, because uncertainty is so wide. It's that dry powder that I think really allows you to make great investments when dislocations present themselves.
Yeah, that's what I tell my LPs. It's like, it's the best time to invest. All the uncertainty, you can just, especially in 23, 24, it was just like a really, really good time to be an early stage investor. One thing AI will never replace in investing.
I think we touched on that a little bit, but I really think it's human judgment. I think it's being able to understand that things that have happened in the past, looking through a model, looking through a pattern, seeing everything that's happened ever before doesn't necessarily prepare you for what might happen in the future. Having that imagination, having that ability to pull something out of the data, out of sample data, that'll allow you to kind of predict the future or at least predict risk. I think human is probably one of the most underrated things that people will always have going for them, no matter how automated everything becomes.
What's the first thing you read each market morning?
So I start most days, this is a pretty boring answer, but just reading, Bloomberg Daybreak, just getting an overview of what's happening in the world, what's happening in markets. I just love to see that common baseline that I think a lot of institutional investors are looking at when they wake up and open their phones.
What keeps you up at night, inflation or geopolitics?
At this point, it's going to be a little bit more geopolitics because, as I mentioned, if we go into a recession, ultimately any short-term inflation may kind of disappear. But I do worry we have like tectonic plates happening. We're seeing a really big change in the global world order, at least post-World War II. And so geopolitics, I think, are going to become more and more of a risk going forward than what we saw even just a few years ago.
What's one lesson from Lehman you still apply today?
So, looking back on my time there, it's definitely around, risk. And I think if you look at Lehman, they were, a really great franchise, really smart people, really scrappy, didn't take anything for granted, worked really hard to get everything they got. But you could argue they were so fixated on following Goldman Sachs or following Morgan Stanley, really trying to catch up with the big boys or whatever kind of analogy you want to use. And so it's really, really important not to lose sight of where you are. The risks that may lay around the corner or, the unexpected events that maybe haven't happened in 80 years or more, but, you haven't seen them. It's really being aware that, risk isn't just what you've seen in your lifetime. It's things that either have never happened before or that have happened before your lifetime. And so just having a larger perspective on, tomorrow may not look like today or yesterday. It may look like something completely different.
Last question. Who is your go-to economic thinker or strategist you always read?
So I love Howard Marks. I think he's such a smart thinker. I think he's such a great investor. He's in an asset class that I don't even really use that much. Distressed debt is not something that we'll typically do on any given day, but he's an incredible communicator, incredible thinker, and he thinks so much about risk. He thinks so much about markets. He thinks so much about human behavior. He is just, if you've never read anything by Howard Marks, you should try to read his letters. He is really one of the best, probably investment writers and philosophers alive today.
Wow, amazing. Where can folks find you online?
So, we're available on northlight.com. You can find us on our LinkedIn page, or Beacon Capital is Beacon, BEACONCAG.com, beaconcapitaladvisorygroup.com.
Well, thanks so much for coming on, Chris. I learned a lot. I'm sure our listeners will as well.
Thanks so much for having me on. This has been great. I really love listening to your show, and it's great to finally be a guest.
Yeah, thanks so much.